Do you want to reduce your tax liability? Today, we'll discuss tax-efficient strategies for individuals and businesses. Tax planning is like a game of strategy. It's about making the right moves at the right time to minimize your tax bill and maximize your savings. The importance of tax planning can't be overstated. It's not just about saving money. It's about setting yourself up for a financially secure future. Over the course of this video, we'll cover a variety of strategies that can help you achieve just that. We'll explore methods for individuals such as contributing to retirement accounts and taking advantage of tax credits. We'll also delve into strategies for businesses, from timing income and expenses to choosing the right business structure. Each strategy has its own unique benefits and considerations, and it's important to choose the ones that best fit your specific circumstances. Ready to dive in? Let's start with tax planning strategies for individuals. One of the most effective ways to reduce your tax liability is by contributing to retirement accounts. Now, you might be wondering, why retirement accounts? Well, let me tell you. When you put money into retirement accounts like 401(k)s or individual retirement accounts, also known as IRAs, you're essentially reducing your taxable income. That's right. The money you contribute to these accounts is often tax deductible, but the benefits don't stop there. The earnings in your retirement account grow tax deferred until you decide to make a withdrawal. This means that the money invested continues to compound over time, free of tax, until you take it out. And here's a fun fact. The higher your tax bracket, the more you might save by contributing to your retirement account. So, it's quite simple really. Contribute more to your retirement accounts and potentially save more on taxes. Remember, the more you contribute, the more you can potentially save on taxes. Another way to lower your tax bill is by taking advantage of tax credits and itemizing your deductions. Tax credits are a dollar-for-dollar reduction of the tax you owe, making them incredibly valuable. Some of the most commonly claimed tax credits include the child tax credit, earned income tax credit, and various education credits. If you're eligible for any of these, they could significantly lower your tax bill. Now let's talk about deductions. Deductions decrease your taxable income, which can then lower your tax bracket and the amount of tax you owe. You can choose to take the standard deduction, which is a set amount, or you can itemize your deductions. Itemizing means adding up all of the individual tax deductions you're eligible for and subtracting that total from your income. Commonly itemized deductions include things like mortgage interest, state and local taxes, medical expenses, and charitable contributions. It's important to note, however, that itemizing only makes sense if all your individual deductions add up to more than the standard deduction. Remember, tax credits and deductions are not just gifts from the government. They're opportunities to strategically reduce your tax liability. So make sure you're not leaving any potential credits or deductions on the table. Health savings accounts and tax loss harvesting are two more strategies to consider. First, let's talk about health savings accounts, or HSAs. These are fantastic tools for saving for qualified medical expenses. When you contribute to an HSA, not only do you set aside funds for future healthcare costs, but those contributions are also tax deductible. This means you can reduce your taxable income for the year. Plus, when you withdraw from your HSA for qualified medical expenses, those withdrawals are tax-free. It's a win-win situation. Now let's pivot to tax loss harvesting. Sounds like a mouthful, doesn't it? But it's a relatively simple concept. If you have investments, you're probably aware that sometimes these investments can incur losses. Well, tax loss harvesting is the practice of selling these investments to realize losses. Why would you want to do that? Because these losses can be used to offset capital gains. Capital gains are the profits you make from selling investments. So if you've made a profit on some of your investments but have losses on others, you can sell the losing investments to offset the gains. This effectively reduces your taxable income. And here's an extra nugget of knowledge. If your losses exceed your gains, you can use up to $3,000 of those losses to offset other income. And if you still have losses left over, they can be carried forward to future tax years. With these strategies, you can save for medical expenses and offset capital gains, all while reducing your tax liability. Finally, let's talk about gifts and inheritance planning. You see, the tax code provides an annual gift exclusion. This means you can give a certain amount of money or assets to as many people as you want each year without incurring any gift tax. This is a clever way to gradually reduce the size of your taxable estate over time. Now, let's talk about inheritances. Inheritances can have specific tax implications. For instance, when you inherit property, it's usually valued at what it's worth when the previous owner died, not what they originally paid for it. This stepped-up basis can save you a lot in capital gains taxes if you decide to sell the property. However, every situation is unique, so it's crucial to consult with a tax professional or financial advisor when planning your estate. By planning ahead, you can reduce your taxable estate and ensure your loved ones are taken care of. Now let's shift our focus to businesses. There are several deductions and credits that businesses can take advantage of. One such deduction is the Section 179 deduction. This allows businesses to write off the full purchase price of qualifying equipment or software bought during the tax year. Essentially, it's an incentive created by the government to encourage businesses to buy equipment and invest in themselves. In addition to deductions, businesses can also benefit from various tax credits. One of these is the Research and Development Tax Credit, designed to reward businesses that conduct qualifying research activities. If your business is developing new products, improving existing products, or advancing its technological footprint, this credit could be significant. Speaking of credits, let's not forget the Work Opportunity Tax Credit. This credit is provided to businesses that hire individuals from certain targeted groups who have consistently faced significant barriers to employment. It's a win-win situation. You help someone in need of employment, and you get a tax break. But remember, it's not just about knowing these deductions and credits exist. It's about understanding how they work, when to claim them, and how they can benefit your business. The rules can be complex, so it's often a good idea to work with a tax professional who can guide you through the process. Remember, every dollar saved on taxes is another dollar that can be reinvested back into your business. Another way businesses can save on taxes is by offering retirement plans and timing income and expenses strategically. Now, let's dive into these two methods. Firstly, offering retirement plans such as 401(k)s to employees can provide substantial tax benefits. The contributions made by the business to these plans are typically tax deductible. This reduces the company's overall taxable income. Furthermore, it provides an incentive for employees, as their contributions are often pre-tax, thereby lowering their taxable income as well. But it's not just about retirement plans. The timing of income and expenses plays a crucial role too. By strategically planning when to recognize income and when to incur expenses, businesses can optimize their tax position. For instance, if a business anticipates a higher tax rate in the next year, it might choose to accelerate income into the current year and defer deductible expenses to the following year. This way, the business can benefit from a lower tax rate on the additional income and a higher deduction value for the deferred expenses. Of course, every business is unique, and what works for one may not work for another. Therefore, it's essential to align these strategies with the specific financial situation of your business and stay compliant with the current tax laws. With careful planning, you can optimize your tax position and maximize your savings. Lastly, let's discuss the importance of choosing the right business structure and taking advantage of the qualified business income deduction. Your choice of business structure, be it a sole proprietorship, limited liability company, S corporation, or C corporation, can make a significant difference in your tax liability. Each structure has its own tax implications, and choosing the right one can help optimize your tax position. Now, onto the Qualified Business Income Deduction, or QBI. This is a tax deduction for pass-through entities, such as sole proprietors, partnerships, and S corporations. The QBI allows you to deduct up to 20% of your qualified business income, reducing your taxable income and potentially saving you a significant amount in taxes. However, there are certain limitations and rules, so it's important to consult with a tax professional to fully understand and take advantage of this deduction. By choosing the right structure and utilizing the QBI deduction, you can significantly reduce your taxable income. And there you have it, folks. These are some of the most effective tax planning strategies for individuals and businesses. We've delved into retirement accounts, tax credits, deductions, and even tax loss harvesting. We've also looked at how contributing to health savings accounts can be beneficial, and how strategic gifts and inheritance planning can reduce your taxable estate. For businesses, we've explored the advantages of various deductions, credits, and the importance of choosing the right business structure. We've also discussed the timing of income and expenses, as well as employer-sponsored retirement plans. And let's not forget the qualified business income deduction for pass-through entities. These are all powerful strategies that can help you save smart and stay tax efficient. But remember, it's essential to tailor these strategies to your specific situation. Tax laws are complex and change frequently, so always consult with a tax professional or financial advisor to ensure these strategies align with your specific financial situation. Thanks for joining us today. Save smart and stay tax efficient.